In the world of finance, we are often quick to forget the tragedies of the past, but the lessons buried in those tragedies are some of the most valuable we have. After all, in a world of ever-changing rules, products, and financial instruments, history is the one constant that can actually guide us through the uncertainty. So today, let's take a history lesson, not a boring one, a relevant one. Because what happened in 2008 explains a lot about the world we're living in right now, including what's happening to Canadian housing, Canadian debt, and Canadian interest rates today. I'm Sebastian, this is Canadian Finance. Education, not advice. Let's get into it. It's the early 2000s. Investors around the world are looking for new, safe sources of return. Stocks and bonds are still popular, but the dot-com bubble at the turn of the century had just reminded everyone that getting your money back from a bankrupt tech company is not straightforward. Investors are nervous. They want something safer. And then someone has a thought. What about mortgages? Think about it from an investor's perspective. A mortgage is a lot like a bond. You receive regular interest payments over a long period, but with bonuses. If the borrower defaults, the lender can take possession of the house. And with real estate prices rising steadily, recovering your losses on a defaulted mortgage is no problem. The house is worth more than it was when you lent the money. It sounds almost too safe. And that's exactly what makes it dangerous. But here's the thing. Investors don't want to buy the individual mortgage of a single homeowner in Brampton or Burnaby. That's too small, too slow, too much paperwork. That's where the investment banks come in. These institutions, with enormous capital and financial engineering expertise, start buying up thousands of mortgages from lenders, pooling them together, and then selling shares of the pool to investors. These are called mortgage-backed securities, MBS. Now the homebuyer in Mississauga is paying their monthly mortgage, and a slice of that payment flows to investors all over the world. Neat, right? Investors certainly think so. Money starts flooding into these securities. And it's not just investment banks doing this. In the United States, government-sponsored entities called Fannie Mae and Freddie Mac are doing the same thing on an enormous scale, pushing mortgage lending into hyperdrive. Lenders love this. Every time they sell a mortgage to an investment bank, they get their money back immediately, which they can then lend to another homebuyer, then sell again, and repeat. The incentive to lend is now almost entirely disconnected from the incentive to lend carefully. Now, other financial players are watching this and feeling left out. Insurance companies in particular want in on the action, so they begin selling what are called credit default swaps, a type of derivative that pays out if a mortgage borrower defaults. Essentially, financial insurance against mortgage failure. On paper, this looks like free money. As long as the housing market keeps rising, the insurers collect premiums and rarely have to pay out. It's a beautiful business model, right up until it isn't. But here's where things start to get genuinely alarming. Speculators realize they can buy multiple insurance policies on the same mortgage, even if they don't own that mortgage. 10 policies on the same loan, 20. The potential payouts keep multiplying, but they're all betting on the same underlying asset. The total value of credit default swaps jumps from $900 billion to over $62 trillion. That is not a typo. $62 trillion in theoretical insurance obligations on a housing market that could not possibly cover anything close to that amount if it turned. As long as prices keep rising, everyone is making money. Everyone looks like a genius. And so nobody asks the obvious question. What if prices stop rising? Here's the problem that was building underneath everything. Because lenders were immediately selling their mortgages to investment banks, they had almost no personal stake in whether those mortgages were ever paid back. The risk was someone else's problem the moment the ink dried. So lending standards started slipping. Quietly at first, then dramatically. Loans were being handed to borrowers with poor credit scores, low incomes, and no realistic ability to make the payments. These became known as subprime mortgages, and some of these subprime loans were genuinely predatory. Teaser interest rates that looked attractive at signing, then ballooned to unaffordable levels a few years later. Conditions buried in fine print that most borrowers never fully understood. But the investment banks kept buying, because demand from investors for mortgage-backed securities was insatiable. So the toxic loans made their way into the securities, and investors, often including Canadian pension funds and institutional investors, were holding them without knowing what was really inside. It gets more complicated. Investment banks were also creating products called collateralized debt obligations, CDOs, similar to mortgage-backed securities but even more complex and even more removed from the underlying loans. They were being sold to investors as virtually risk-free, even as the underlying mortgages deteriorated. And then, because there weren't enough real mortgages to feed the machine, financial engineers created synthetic CDOs, bets on whether other people's mortgages would be paid back. Pure speculation, abstracted layers away from any actual house or any actual homeowner. The question you're probably asking is, where were the rating agencies? These are the organizations that assign safety ratings to financial products. Surely they would flag the risk building in all of these securities? They did not. In fact, 75% of CDOs, products packed with deteriorating mortgage loans, received the highest possible safety rating, AAA, the same rating as government bonds. Why? Because the rating agencies were paid by the same banks whose products they were rating. The conflict of interest was total, and nobody in a position of authority forced the issue. By October 2007, 3% of all U.S. home loans were in the foreclosure process. Another 7% were a single missed payment away. The cracks in the foundation were becoming impossible to ignore. As foreclosures increased, investment banks found themselves holding real estate instead of mortgage payments. They began flooding the market with foreclosed homes to recover their money. Supply surged, demand fell. And in 2008, American housing prices did something that the entire financial system had been built on the assumption would never happen. They fell. Significantly, and all at once. The domino effect was immediate. Despite 75% of CDOs having received AAA ratings, 70% of them defaulted. The insurance companies that had sold credit default swaps faced payouts they simply did not have the money to cover. AIG, one of the world's largest insurers, required a government bailout of 180 billion USD to stay solvent. Investment banks stopped buying mortgages from lenders overnight, credit froze. Companies that relied on short-term lending to operate lost access to that funding in days. On September 15, 2008, Lehman Brothers, an investment bank with $600 billion in assets, filed for the largest bankruptcy in American history. Markets around the world collapsed. Investors pulled money out of everything and moved it into government bonds, one of the only things that still felt safe. The Dow Jones lost a third of its value. The TSX in Canada fell more than 35%. By 2009, the global economic engine had effectively stalled. 2 million American jobs were lost in the final 4 months of 2008 alone. The recession technically ended in June 2009, but the financial and human impact would be felt for a decade. Now, Canada. Because we can't just file this away as an American problem. Canadian pension funds, institutional investors, and banks had exposure to these securities. The TSX dropped 35%. Canadian exports collapsed as American demand evaporated. The Bank of Canada cut its policy rate to near zero and kept it there for years to prevent a deeper recession. Those near-zero rates, as we now know, had their own consequences. They fueled 15 years of rising Canadian home prices. They made variable-rate mortgages irresistible. They encouraged Canadians to take on record levels of mortgage debt under the assumption that cheap money was the permanent normal. And when the Bank of Canada was eventually forced to raise rates sharply in 2022 to fight inflation, the echo of 2008 was in the room. Not because Canada was doing the same reckless things, but because the conditions created in response to 2008 had created their own vulnerabilities. The financial crisis also introduced something Canadians now live with, the mortgage stress test. Introduced federally in 2018, it requires borrowers to qualify at a rate higher than their actual mortgage rate, precisely so that if rates rise, they aren't immediately underwater. It's a direct policy response to the lessons of 2008, not perfect, but it exists because of what happened. And the kicker to all of it? Despite financial institutions being the primary architects of the 2008 collapse, they received the largest share of government rescue money. The banks were saved. The homeowners who lost everything largely were not. The Dodd-Frank Act was introduced in the U.S. in 2010 to impose new regulations on lending and financial products. But the fundamental question of whether financial incentives that disconnect risk from consequence can be made safe remains unanswered. So what do we take from all of this? When lenders don't care if loans get paid back, lending standards collapse. When rating agencies are paid by the people they rate, ratings become meaningless. When financial complexity separates risk from accountability, the whole system becomes a bet that nobody is honestly pricing. That's not ancient history. Those dynamics exist in different forms today. And understanding them, even at a high level, makes you a more informed investor, a more careful borrower, and a more skeptical reader of financial headlines. The 2008 crisis happened because a lot of smart people convinced themselves that the rules of basic finance didn't apply to them. They did. They always do. If this gave you a clearer picture of how the modern financial system actually works and fails, hit subscribe and turn on notifications. Every week, I break down the financial history, strategies, and decisions that matter most for Canadians. Drop a comment. Did you know about credit default swaps and synthetic CDOs before today? I'm genuinely curious how many Canadians have ever had this explained to them in plain language.